We're going to bring up three people who are exceptional in the deal-making environment and are experts on the deals that are taking place within the beverage business right now. To take us into the deal room, we've pulled an all-star team. Mike Burgmaier of Whipstitch Capital is going to represent the investment banking side of the team. Tom Spier of Boulder Food Group is going to talk to us from the perspective of the investor. And Nick Giannuzzi of the Giannuzzi Group is going to be our legal advisor. Please welcome the team to the stage. And I welcome you all to send up questions about this critical juncture of a company's development. I'm going to ask a quick question. I see you guys all got the Ascension memo. What's deal flow like right now?
There are a lot of deals going on right now. Big ones, small ones. One of the questions we had talked about on the phone today was quality, the quality of deal flows. And I think there's always going to be, there are good deals and there are bad deals. And I think a lot of what we all do is to try to work our way through those and help pick the right ones. Like when we worked with Kavita and Spindrift, it was fun to see the BevNet agenda today and like being surrounded by the companies that we worked with. But there are a lot of deals happening at an earlier stage, I think, than I've seen before.
And now, Tom, your team has done a couple of beverage investments, and they've been pretty early stage. So what are you learning about that business right now?
Yeah, I'd say that, well, first of all, it does ebb and flow. I felt like the deal flow had been a little soft in some ways, and now it seems to really be percolating again, especially at the earlier stages, which is where Boulder Food Group works. The two investments we have made are in Chameleon Cold Brew and Malk Organics, and I do have to thank BevNet because as a place to curate ideas and try to identify products and concepts that are really going to set themselves apart, it's just been a fabulous way to intersect with these brands. So, we really are looking for concepts that are really not just sugar delivery mechanisms, but ways to deliver health and wellness. And I think that's really the huge shift that we're seeing and why so much volume is moving from the traditional legacy brands to these, really interesting and innovative upstart brands.
I'm going to ask you a question, so I just want to pitch it back to Mike to say, are a lot of investors looking for what Tom is looking for right now, and are they finding a satisfying number of companies?
No. There are a lot of investors looking for early stage deals. There are ones who are still focused on EBITDA that don't understand this space. There are ones that say, I need to see 10 to 20, $30 million in sales. We worked with Kavita and Essentia. One of the interesting things is I always think the right investor finds the right company and the right deal, and the funnel kind of works. But with Kavita and Essentia, we have investors coming up to us saying, oh, I see the numbers and I see what's happening in the marketplace. I'd love to get in. And we say, the next transaction with that company is going to be a strategic acquirer. You are 18 months too late. So you have to be able to see the things that are good early.
Now, that means that there's some power in the entrepreneur's hands right now because there are so many people who want to get in on that next big deal. So are there demands changing right now, and are the deal terms changing, and how's that affecting deal flow?
This is the longest I've ever sat here and not spoken. I realize that.
Sorry.
So let me respond to all three of those questions.
Counselor, the floor is yours.
The market, in terms of the transactions that are happening right now, is, in my opinion, absolutely on fire. we get a call, once a week with another brand that has an opportunity to sell. And, both the big brands and, the ones that you're going to read about for hundreds of millions of dollars, as well as the smaller brands. And the acquirers are the traditional acquirers, in the space, and then there's private equity funds that are saying we want 80 or 100% of this brand, and we're willing to pay $20 million for it. So it is just so exciting right now. I mean, my whole team, we're running basically around the clock with these deals, and I think that's mostly good for the whole community. In terms of being positioned to do these deals, there's a lot of funds, like Mike said, in that space that want to spend a lot of money and put a lot of money in, but there's not a lot of funds, and there's certainly not a lot of qualified funds in the position that Tom's in, which makes them very unique in the market, because for the entrepreneurs, and this sort of gets back to the question to me about, what's the entrepreneur's position, and are there opportunities changing? Are they looking at the investment alternatives differently? For small brands, there's a lot of dumb money out there, and dumb money can be very good for you. You can do a transaction with very simple terms where the investors don't have any rights, they don't have any controls, they don't have any say, and for some entrepreneurs, that's the perfect early round investment. Other entrepreneurs, like something we're working on right now together, they really need guidance, and they really value what a qualified PE fund of experts in the industry can bring. And so for those entrepreneurs that are looking for the smaller type transactions, maybe as a first round of financing or a second round of financing, it's tough to find really good investors, but they're out there.
Tom, you're a former entrepreneur. I'd argue still an entrepreneur, and one of these qualified funds. Do you see the value of this dumb money that Nick's talking about?
Well, I don't know. I'd say in some cases it's folks, friends, and family, and if those are the folks that truly believe in the entrepreneur, and it allows the entrepreneur to get off the ground and then work their way forward toward advisors like Nick, like Mike, and potentially like groups like ourselves, I think it's an essential part of the ecosystem. As you work up the capital stream, there certainly is some money coming in that may not have all the insights that we have at this stage, given how long we've been working in the space. But I think having the liquidity in the system is important. Hopefully it cuts both ways. If it gets a little bit more expensive getting in, hopefully it works on the other end coming out. But every case is a bit unique.
Is it getting more expensive for these guys to get in?
Valuations are strong right now for entrepreneurs, and both at the early stage where it's just sort of a dream, and they say, we have a product, we're just getting started, we're out there, and we think we're worth a lot of money, as well as the companies that are growing well, the multiples are good. And I think it probably creates a lot of pressure on the funds because they want to make money along the way, and a lot of the entrepreneurs period out there have maybe not an unrealistic expectation, but they hear about the transactions, and there's 20 transactions in a year or exits in a year, and they pick the two, at the 6x. So everybody thinks they should get a 6x on revenues, and that's not always realistic.
So are things getting unrealistic, Mike?
I think they get unrealistic to what Nick's talking about when your company doesn't have the metrics. You don't have the 50 to 80% growth. You don't have the margin gain. You don't have you're not selling off the shelf. You're not seeing that laddering up on baseline sales, promotion lift. After promotion, you're 20% higher, and it happens time and time and time again. They hear the 5x, they hear the 6x, and they want it now. They want it on forward sales, but there's no proof.
Let's talk about one of these deals that's out there. It's based on an audience question. There's a certain level that we're now going to call buy X in terms of valuation. Now there's been a downward revision in some of that company's revenues going forward. How's that affecting those deals that are sitting downstream?
I think it's such a case-by-case basis, and still for the marquee brands, the ones that are really resonating with consumers, they may seem like they're priced for perfection at the early stage, but if they perform like you expect and like with the consumer engagement that you'd expect, then they still are able to achieve the exit multiples on the other end. I do think that typically when a lot of these brands are acquired by strategics, there is some shakeup, and execution and transition is just part of the game. But the acquirers, if they're really good at their jobs, can work through that.
In terms of the other companies that are probably cherry picking those kinds of exits, though, as a way of representing their valuations, I mean, is that something where investors are going to say, you know what, that's not part of the conversation, that buy deal?
It's a cheap answer, but it's going to depend on the company. It's like buying a house. You fall in love with a certain house and you pay more for it. I mean, there are certain buyers that want certain brands. We sold a company a couple of weeks ago, and the buyer knocked on the door and said, I have to have it, and the founders and the company were in a position to negotiate a very high price. So, I think it's when you run these, ultimately most of the companies, when they get to a certain size and they're ready to sell, you run a process, and theoretically, it's a perfect system and the market speaks as to value. But the quirky thing about it is, behind the scenes, people hear about the exit and they say, oh my gosh, that was a great multiple. It doesn't mean there was 10 bidders. Sometimes there's only one bidder who really, really has to have it, and they don't know who else is bidding. And so it's possible, if it's well run, you have a great advisor like Mike guiding you, and he can help guide that price up. So it's really, I take it all with a grain of salt. We'll sell 20 companies this year, we think, 15 to 20 companies, and I can't pick the ones that are going to go at a 5x or a 2x, because it's so much dependent upon the appetite of the buyers at that moment.
I can.
That's why he gets paid for that.
How many extra points do you get for the perfect prediction?
The perfect position?
Prediction.
Oh. You can't predict, but you can get close, and you should understand what a company should go for. But Nick is right. At the end of the day, it's a market of one. It's a buyer of one. We've had processes where, and I will not say which one, where the ultimate buyer outbid themselves and was 50% higher than number two. And that can happen. But there has to be the threat of competition. If someone wants to buy something early, then they got to pay up for it, and it's in the positioning, it's in the growth, and you have to. Companies don't understand this as much too. You really have to pick your time, because you don't. It's the competitive landscape as it exists at this moment today, and today only, that matters, because it might be totally different 6 to 12 months down the road. And we've seen companies that grew 50%, but they were worth less after that growth than if they had sold 12 months prior.
Why?
Competitive dynamics. Someone else came out of nowhere, grew, changed things. Like a DPSG buys a buy. The checkbook is closed for a short period of time or a longer period of time. We don't know. But there are, the decisions that are being made in the boardrooms of the large strategics. They're thinking ahead of time about what they want to buy, what categories they want to go into, whether they're going to make it themselves or buy it. And options open and close.
Or from banging your head on the ceiling. You grow like this, like this, like this, and you think it's going to go on forever. You wait too long, and your sales start to go, and suddenly, when you're not growing at 50, 60, 70%, but you're growing at 20 or 30%, the buyers are no longer thinking multiple of revenues. They start to think about multiple of EBITDA. And most of the young, fast-growing brands are not dropping a lot to the bottom line. They're trying to grow quickly. So timing's everything.
And do you see companies able to pivot to remain as sort of operating concerns and be successful that way? Or if they're pursuing that kind of unicorn strategy, are they stuck?
I just think it's, again, I hate to be repetitive, but it's so specific to the brand and the brand strength in the market. And I'll make an example in the food space, Noosa yogurt, that has really just been exceptional. It's a Colorado-based company. They traded at a very, very premium price 3-4 years ago, and today, I don't know how much larger that brand is, but I know that it is performing exceptionally well in the market. And yesterday I was in Stamford at the train station, and there was Noosa ads everywhere. And the way that a larger strategic or private equity firm in this case is able to deliver a message to the consumer and continue to drive that growth, it's absolutely achievable.
We sold a brand about 4.5 years ago, and I remember when we sold it, we got an amazing price, an amazing multiple, and I remember thinking to myself, gee, I'm glad this buyer is here because I don't really know what would happen to this company tomorrow, because you're driving sales so much, some of these brands, that you don't deliver anything to the bottom line. And I was speaking with the buyer, and the acquirer told me that the brand continued to grow. They started to modify certain things, improve margins, and it's adding real EBITDA to the company, and that they're really happy with it. So, the strategy in my opinion, just oversimplifying to grow your business, is basically try to double every year. Don't worry about any bottom line profitability, but worry about margins. Because ultimately, if you do that and you can either have reasonable margins or a pathway to reasonable margins, and you're winning your space and you've got good branding, you're going to have a real opportunity for an exit. The problem with that is you can do that for a while, but sometimes you run out of runway depending on the type of brand you have and how niche-y it is. And so timing that sale or going out to the market, trying to create a sale transaction is really crucial for some of these brands.
And I would add to that the capital structure and your investors.
Exactly.
If we are an earlier investor, we are not a mega fund. The beverage business is notoriously an expensive place to build a business. And, I think you have to realize that some of these businesses really do need a deeper pool of capital.
And
Well, and when you're doubling too, I just want to say that make damn sure that that's not distribution-led, that the velocity is the number one. That the doubling better be a nice mix of velocity gains and distribution gains. Distribution alone is not where the value is.
let's flip it for a second. We always talk about the metrics that investors look at when they're looking at companies. Question from the audience is, what kind of metrics should the companies look at, particularly in a hot market, when they're looking at investors? And that was followed by a question that said, what percentage of your investments make you money? So that may be the key metric. I don't know, but I mean, what do y'all think when you're looking at investors? What are some of the things that the entrepreneurs should be checking out?
I mean, one of the things we always say is that you have to look at the individual who will be on your board and what they've done before. Because even sometimes firms are so large that the individuals diverge pretty drastically. But we're kind of say, look, the only thing about a business plan is that nothing will happen according to plan. So when you're in the board meeting and things are different, are you going to have an adversary across the table from you or a partner? So I really think, Bill Moses spoke about Alan Karp and being a management-friendly investor. I think that you need that. So you need to understand and kind of do the track record, and the metric is to talk to people who have had that investor previously.
What I was going to say is the great thing about this industry is it's small. People are very, very helpful. People are willing to take a phone call. They're willing to talk to you. Whenever we have an opportunity, we have an entrepreneur looking to raise money, there's 3 funds that they're talking with. We connect them to our other clients that have them as investors, because there's nowhere to hide in this industry. Everything is absolutely transparent. So if you're, a private equity guy who cares more about squeezing the last nickel than making sure that the founder's also happy and trying to create that appropriate balance between making money and being appropriate, being part of the community and helping the community, then people are going to find out. So for me, that it's there's perfect information out there for virtually all of the PE funds, because they're generally focused on the space. and you can find out who the ones that just, are not good and that you shouldn't be in business with.
Wouldn't you say that's changing a bit, though, with the number of people coming in from Silicon Valley, with the number of family offices that are coming in, with the broad push of strategic VCs that are getting involved? I mean, it's a thicker pool now.
We did probably 70 financing transactions across the table from private equity last year for our clients. 65 of them were with the usual suspects. 5 of them were sort of new entrants into the market. So for those people, there won't be as perfect information. You have to do your due diligence just that much more.
Is it getting tougher for you with these folks coming in?
I do think our windows are tighter. On the food side, which I traditionally have more experience in, we're pretty comfortable being pretty early, very early in some cases. On the beverage side, we try to be a little bit more patient, but with as much money as coming downstream, it can be a pretty tight window before, the deal is moved beyond us and maybe to a much, much larger institution. So we just have to be really on our game, really watching the market, watching the cold cases, and obviously interacting at events like this with individuals in this room.
See, here.
It all happens here.
Yeah. Past couple of days, as I'm sure you guys have been aware since you've been watching Wrapped, we've been talking a lot about e-com, and I wonder how much importance investors are putting into the development of that. And I know it's going to be company dependent, but how much they're looking at that as sort of an extra factor in company performance.
I think it's important. Obviously, it's got to be a shelf-stable beverage and be able to do that. But food and beverage, it's really a sign that customers are pulling your product, and if you don't have wide distribution yet, that they're searching it out. They may have had it somewhere, and they want to get it, and they can't buy it at their local store, or they want to have 20 to 40 of them a month. It's not just a grab and go. I need something right now. I need it consistently. So if you have seeing that it's a velocity gain. But we've worked with companies where their Amazon sales grew 20% a month, and the sales were maybe 25% of the company's overall sales when we did a first round. Those are very valuable sales.
Even though we hear about compressed margins due to one of the things we hear from companies, they just can't make money in e-com. And is that something that investors also consider?
I don't think it's true. I think that certain brands can make money in e-commerce, and obviously that's not every brand. But if these companies establish the right supply chains early on, it is achievable. And I would be curious to talk to some of the bulge bracket firms in e-commerce like Jet and have a sense of the volume that's moving in beverage relative to other parts of food. And it may be a bit different. I think beverage tends to be more retail focused.
If they can get it right in e-com, I imagine that's a positive sign, right?
Just one observation. I'd say this year, maybe the last 12 months, I'd say maybe 1 out of every 4 or 5 new clients that we have tell us in the first meeting we're e-commerce only, and that's where they want to start, and maybe that's where they want to stay. Over time, that evolves, but there's clearly a shift, and the entrepreneurs are looking at that as a cheaper way to get out and to get their name recognized and create sales.
And that's fascinating. How are investors reacting to that?
I think the jury's still out a little bit on it.
Yeah, we are becoming increasingly excited about seeing the traction in e-commerce, knowing how important omnichannel is becoming and how much share is shifting to e-commerce. We are not likely to invest in a brand that is simply going to be an e-commerce strategy. It may be a great approach for a business, but it's not going to be our approach. And but that's as a testing ground, and certainly within Instagram and the social networking environment, understanding how that's creating this virtuous circle in how consumers are interacting with the brands and sharing those brands with their friends.
And I think the right way to market too. I mean, we've been seeing a lot more with podcasting too, and just having the right kind of targeted message go out through a podcast, leading to e-commerce sales, and a bump, because they can, through a certain podcast, depending on what your product is, you can really target the right consumer.
In bringing up podcasts, you also bring up other media. And I just wanted to say, we are going to continue our live stream lounge throughout the break that we need to go to right now. And we're going to be back with the showdown at 10:40. So thank you guys so much.
Thank you.
Thank you.